So to continue on here, central banks and money supply. When interest rates are low, more money in the money supply, right? So if we go back to this, right, you could see the interest rates are low. If you look at SM2 and then I2, interest rate 2, when the interest rates are low, there's more money there. There's also more demand for the money because people know they don't have to pay as much back, right? Um, Central banks can lower the reserve ratio, more money in the money supply. So the reserve ratio is this: commercial banks are required to keep a certain amount of money in their well, how do I put this? A certain amount of money in their actual vault, if you will. So right now, currently in the United States, it's about 10%. So if you go, it depends. So that amount of money could change depending on the volume that the bank does. So if you know if there's a really busy bank somewhere, they might have lots of customers that go to that specific bank, and they're required to keep 10% of their total investments from people. And the rest of that they can use up to do the things that we talked about in the previous part of this lecture, which would be to buy bonds or give loans, right? And to try to make some money because, again, they are a commercial entity. They are a business. They want to make money. So 10% right now. And they can raise or lower that depending on what they want to do. So if they lower the reserve ratio, that means there's more money. So you can guess that if they raise the ratio, then there's less money in the money supply. Central banks can affect the discount rate, which we just talked about, interest rates of commercial banks. So we already talked about if the discount rate increases, then commercial banks will have less money. So that's just how that goes. If the interest rates are lower, then they'll have more. Central banks can also sell or buy bonds, so the government debt. The government basically puts out IOUs, so this is why the government bonds are so interesting. Basically, it's another way for the government to bring in money. And when you saw in the last lecture where how the government, I should say, not we, but how the government chooses to spend its money, we've pretty much always operated in a deficit, and as a result, you would have the government buy, or central banks or commercial banks buy those bonds in order to make sure that they have a steady revenue stream coming in. But if central banks buy back bonds, commercial banks have more money in reserve to increase the money supply. So if you look at why they do that, it's a fairly important thing that they do. Here are a couple of things. This is only to 2010, but I basically wanted to show you the capacity for utilization, aka manufacturing, versus the effect of federal funds rate. So like they kind of have very similar looking trajectories, right? One is a little bit lower, but you see in the 1980s, like the effective federal funds rate is much higher. That's kind of an unusual thing to look at. So that's an interesting indication as far as like recessions are concerned. Like those rates are usually a little bit higher and therefore affect things a little bit differently. Over here we have the interest rate for the last 10 years. Typically it's stable. And when the economy is growing, more often than not, the inflation rate really should be higher. So like in 2011, when we were coming out of the Great Recession, or at least initially, our interest rates or inflation rates rather, appeared to be growing, which is normal when your economy is growing. But then it dropped back down, and we really haven't experienced since then. We've had nothing but GDP growth, but we haven't seen a growth in inflation, which is, like I said, kind of unusual. And a lot of people expected inflation rates to hit. If you look up before the coronavirus hit, you could probably find information that would talk about how inflation rates, they were expecting a bomb to drop, an inflation bomb. Lastly, take a look at this. This is interest rates, and you can see from 95, the average is usually bang around 6, dropped significantly in the early 2000s, went back up, and then we had the Great Recession, and it's pretty much flatlined since then and stayed pretty stable. What you're going to notice in 2020 is because of the coronavirus, it just completely went vertical. We are close to zero on our interest rates.